everyone. You're all welcome to the maiden edition of the webinar series organized by Connect Consult in collaboration with Center for Business Development, Innovation and Growth, CBDIC. And today's topic is responsible investing. Shall we pray? We thank you, God Almighty, for this day. We pray that as we are going to begin this event, may you be with us in Jesus' name. Amen. So today's webinar will be given to us by our own brother. He's called Mr. Obed Odente. Now, Obed is a professional investment manager and currently works with IC Asset Managers as a fund manager. So, Obed, if you can take it over from here.
Good afternoon to everyone. I believe it's an opportunity for us to learn, to have some meaningful conversation. So far as investing is concerned, we have seen so many people who are not so much investment inclined, have so many questions on their minds as to what to invest in, how to invest, and how to do it and do it safe. On this background, I want to share with you something brief on investing, and I'm captioning it responsible investing. As we go through this, you will understand why this caption, and then we'll be able to draw very meaningful insights from it. Okay, responsible investor. I'll first of all like to begin with some definitions so that we can understand the rationale behind this caption. So what does it mean to be responsible? To be responsible simply means making good decisions and caring for others. So usually when we say a responsible parent, you know it's a parent who make good decisions for the children and also cares for them. Just that, by the way. Now let's look at investing. Investing is the act of allocating resources. And this time we're talking about money. What's the rationale for this? It's usually to invest in a business or buy an investment product or an asset. Your main expectation for doing this is to generate some profits or some income. You wouldn't want to sacrifice your money today for the future without gaining anything. So in brief, investing is allocating your resources into something that in the short term or in the long run, you believe that it will yield some profit or income. If you put these two terms together, we get to understand responsible investment better. That is, you investing or making good investment decisions and caring for that decision or for that investment that you make. What we have realized in recent times is that people are really enthused about the sort of returns that they make on their investments without necessarily putting in the appropriate measures to care for the kind of product they invest in. So we realize that at the long run, there have been occasions where people have invested and they have lost all that they invested, mainly because they didn't put in appropriate measures. Maybe they make good investment decisions at the time they were investing, but mainly because they didn't follow the investment to be sure that whoever they have given the funds to is continually putting it into good use, and it will continue to reap the kind of benefits he or she is earning. It ends up being a bad one, and even the principal that you invest, you probably may end up losing that principal. To care for it. We'll continue by looking at some investment vehicles. One may ask, when we talk about investment vehicles, what are we referring to? Investment vehicles are assets offered by investment industry to help myself and yourself to be able to put our money into it, so that from the present into the future, we can have some value, in the sense that whatever products we invest in, we can be able to generate some returns. So any products that we see out there that we put our money in, that we have the motivation that in the future we will have some income or some profits, we can term such instruments as investment vehicle. Now, a few examples I've listed here are shares, bonds, warrants, real estates, such as gold, and the likes. These are just a few, and I'll cover just a few as we progress in the presentation. So let's start with looking at a bond. We'll talk about bonds. A bond is a loan to a company or to government. So usually we hear that government of Ghana is trying to raise funds by issuing $1 billion bond to finance government projects and all that. So this is a form of a bond, and we call that a treasury bond or government of Ghana bond. That's for Ghana. In the US, they also do same. So we call it the US treasury bond. And also we have corporate bonds. Those are bonds that are usually issued by companies to finance their operations and projects. Now the intention is to pay back a fixed rate of return. So it is government that is taking this loan. Government has to pay back a fixed rate of return for investors like yourself and myself when we tend to invest in such an instrument. It's a safer investment than stocks, but it still has some risk. And to just give a little explanation around this, the reason why a bond has a risk is that, yes, you are assured of your return. You know you have about 20% of return to receive, let's say, every year. But the question you ask yourself is, if the company you are investing in, the company that issued the bond, is not able to make good investments with your money, the company may end up winding up. And once the company goes bad, you will not be able to retrieve your money. So yes, there's some level of risk, even though you are assured of your returns. And that is the risk we are talking about here. We'll be looking at stocks, and we'll understand why stocks or equities seem to be a bit riskier than bonds. Okay, so equities or stock is also a capital raised by corporations through the issuance and distribution of shares through financial markets. So for equities, unlike bonds, equities do not promise fixed returns. You are only assured of appreciation in the price of the share you buy. And that is the only hope you have. And it's a hope that you cannot be assured of, because depending on how the company is doing, that is when people will be interested to and willing to buy the shares at higher price than it was issued. And when someone is willing, or investors are willing to buy at higher prices, then you are sure that you bought at a certain price, and you can sell at a higher price to make some profits. But if the company is not doing so well, you're not so sure that you're going to get some profits. You may even end up making losses. In this perspective, I want to draw that line to explain why equities seem to be more riskier than bonds. Like I did indicate, for bonds, you have a fixed return. So in terms of return, you know that you are getting X amount, or you are getting 20% in a year. So you are guaranteed, or you are assured. But for equities, you're not guaranteed in any way. The only thing that you probably look at is the dividend, and the dividend still relies on the performance of the company. If the company does well, they declare dividends, you can enjoy some. So to explain why equities look much more riskier than bonds, it's two things. One, your returns is not assured. It's only when the company does so well and then investors are willing to buy at higher price, or the value of the company goes up and people think that the stock is supposed to be selling at a certain higher price. That is when you are assured of it. The second aspect is whether dividend will be declared or not. When the company is not doing well, you're not assured of any dividend being declared for you to enjoy. But for bonds, at least if the company continues to do well, you know that you get your 20% and it's assured. So this explains why mostly we hear that equities are riskier than bonds or fixed income investments. Let's look at treasury bills. A treasury bill is more or less like a bond, but it's not a bond. Let's put a caution here, it's not a bond. It has some similar features like a bond because it's also a debt instrument that you are assured a certain rate of return. So maybe you go to the treasury bill market or you contact a broker to buy a treasury bill, you go to a bank to try a treasury bill, they're able to quote you a rate. Currently, treasury bill rates around 12% to 13%. So you are sure that, yes, if I continue to do this investment over 1 year, I'm getting 12% or 13%. However, the difference between treasury bills and bonds is that treasury bills are issued at discount. So if you want to buy, let's say, 1 million treasury bill, you may pay less for it. The difference between what you pay and what you get at the end of the period is your return. For bonds, if you are investing 1 million, you invest the full 1 million today, the 20% will come back as your gain or as your return at the end of the period. So you buy let's say 1,000 Ghana cedis. At the end of the period, if it is at the end of the year, your principal, let's say 1,000 is still there, it's still in the investment, but you are paid the percentage of return. That is say 20%. If it's 20%, no, it is 200 cedis that is coming to you. So if it's a 3-year bond, you know that for every year you're making 200 cedis that will be paid to you. Just to draw another line between treasury bill and bonds, usually bonds are long-term. So usually bonds span from, let's say, 3 years, 5 years, 10 years, and beyond. So you lock in your money for that length of time, and you earn your incomes or your flow of income from one period to the other. So if it is yearly, that interest will be paid. At the end of every year, your interest is paid to you. But in Ghana, most of our bonds are paid in 6 months. So if it's a 20%, let's say 10% return is paid to you every 6 months. So at the end of the year, it makes up the 20%. But for treasury bills, it's a short-term debt obligation that is backed by governments, which governments also use to finance their businesses and their activities. So usually treasury bills spans between 3 months, 6 months, and up to a year, especially in Ghana. So this is the difference between these two fixed income government securities. So we have government bond and then we have government bills. That's treasury bills. Now, we also talk about another investment vehicle, that is certificate of deposits. These are products that are usually issued by banks, and they also give fixed interest of return. It's usually up to 12 months, just like treasury bills, but treasury bills are issued by government. Certificate of deposits are usually issued by banks. So that's the difference. And as such, their risks are also different because governments, we all believe investing with government is safer than investing with a bank. But once the bank is a good bank, you do not have much to worry about. And that is why we all need to be very careful, and then we make sure that before we enter into any investment, we are sure that the institution is a good institution. Another vehicle is mutual funds. It's usually a type of financial vehicle that is made up of pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and others. Unlike, let's say, a treasury bill or a bond, which is a single security you're investing in, mutual funds have different characteristics. It's usually a pool. And what I mean by this is that usually investment professionals in a firm that has these products, after monies have been collected in favor of this fund, based on their investment expertise, and then based on the objective of the fund, they look for instruments or other investment vehicles that will offer investors the return they want, the safety they want, and be able to meet their objectives. So just to throw a little more light on this, for mutual funds, and I'll give a typical example of one mutual fund that we have in Ghana, that is the DataBank M Fund. With this fund, you walk into, let's say, a branch, you register, you deposit your cash. And then what happens is that you do not state that you want to buy, let's say, a bond, or you want to buy equities or whatsoever. But the fund has certain objectives or certain characteristics. And when those characteristics matches with what you also want, then you go in for it. For example, that particular fund is for usually short-term investors who don't want to take on so much risk. So that fund usually invests in, let's say, treasury bills. They invest in certificate of deposits with good banks just to make sure that you are secured. And they invest in these short-term investments so that people who really want to invest very short-term and come for their monies more frequently than investing for a long term can easily access their monies when they want it with some reasonable level of return. So then experts select the kind of investment vehicles that they need to put together to make up this pool of securities or make up this pool of investments just to meet the objective that you are looking at. So usually mutual funds are either short-term focused or long-term focused with the level of risk that the client is ready to take. So the example I gave are usually for people who do not want high risk. So when you want to do any mutual fund, you need to contact someone who have the expertise to be able to recommend what actually meets your level of risk and the goal, your investment goal. As we proceed, we will get to learn more about this. So this is just a simple graph indicating that investments of the various investment vehicles do not fall on the same level of risk. They fall on different levels of risk. Some are much riskier than the others. And like I've indicated, things like stocks, if you look at the extreme at the right, at number 5, individual stocks are riskier. I've explained in the earlier slides, mainly because you do not know where the price will be in the near term. You're not assured of the performance of the company and all that. When it comes to the extreme left, number 1, stuff like maybe returns that you make on your savings or investing in treasury bills or investing in fixed deposits are also investments that are a bit more safer because they are short. And then also for treasury bills like this, they are more government guaranteed. So depending on whether you want to take a more risk or not, you need to know which investment vehicle you want to venture in. Now let's look at principles of successful investing. You must know yourself, know your goals. Why do you want to invest? Have a well-written and thoughtful goals. Know your budget. You cannot earn about 100 cedis and you have expenses of about 90 Ghana cedis and you say you want to invest 20 Ghana cedis. you need to have a budget. So once your budget tells you that if I do all these things, these basic things of life, and I'm left with 10 cedis, they know that, okay, by my budget, I can invest 10 cedis and invest comfortably. You must know your ability to tolerate risk. If you see your friend investing in something that is risky, he doesn't really need to invest in that thing. It depends on your risk appetite. And one clue I would give in terms of determining our risk appetite is this. It's not about how brave you think you are. First, look at your background and look at how solid you are financially. Maybe you could have a friend who has a very good family. He can choose to put all his earnings in a risky investment. If he loses it, he knows he has 100,000 fund somewhere that his father has secured for him. If you lose, you can go back and tap into that fund. But maybe your story is different. So such a person have high level of risk, a high appetite for risk than you. So let us not follow our friends when they are making investment, but rather let's just look at our situation, our conditions, and look and determine the level of risk that suits us so that we can protect ourselves and edge ourselves from the level of risk that comes with investments. The next thing is stay diversified. The next thing is stay diversified. What that means is that you not invest in just one thing. Even in business, you usually see people trying to invest in different things so that when the situation changed, like COVID came, if I have invested in different stocks, I may be secured. Assuming I've invested in MTN shares, I've invested in, let's say, a cocoa company on the exchange. During COVID, consumption levels went down. People were not consuming cocoa. People were not consuming chocolate and all that. So if I invest in a company that does these productions and then consumption is low, definitely to affect the stock price. But if I have another investment, let's say MTN, and then during COVID, a lot of people working from home, people were using the internet. So profitability was booming because everyone was online. So you see that once the cocoa one or the chocolate one is going down, the telco one is doing well. Why? Because profitability is high because everyone is online. People are no more doing physical business. People are doing online business and all that. So we need to try to diversify in terms of the investment that we do. And it's always risky to put your money just in one place. The other is know what you invest in. There are some of us that we do not understand what we invest in. We go with anything, whatever we think is available that is okay, and then the returns are guaranteed. We go for it. But I want to tell you, when investing in individual assets or in any investment vehicle, do your homework. Know the key financials and the strategic position of the company. There are some of us that, I mean, once they say you want to invest, you ask the only thing you're concerned about is which one is giving the highest return. It is not right to do that in investing. You must first of all think about the money you're putting in. Whether the money that you're putting, where you're putting in, that money will come back to you or not. And that is why in recent times, I've seen people who have invested and they have lost all that they invested because they were trapped with good returns without necessarily thinking about the good standing of the company they are investing in or the reputation of the people that are managing the kind of investment products they are investing in. So let us be mindful. Another principle, another thing that we need to consider in our successful investing is invest only with high quality, licensed and reputable people and institutions. It is very important. And I think in recent times, most people have overlooked this. And because of that, they have lost their monies. I want to entreat that do not be too much focused about the returns. It is important, but your money that you're investing is more important than that. Because if you're investing about 10,000 cedis, and you're chasing getting 1,000 cedis in 1 month, and the next 3 months you lose all the 10,000, and then the return of 1,000 is not coming again, you've lost big time. So let us not be too focused on making huge returns. But aside from that, let us try to make time to ask questions, contact people who know more, to give us more education rather than we following returns and following bad advice. Investing or investment strategies. We have value investing, income investing, growth investing, social responsible investing. Warren Buffett has this principle that you buy stocks that are cheaper than they should be. And that is value investing, because when you buy cheaper, you are sure that at a certain point in time, when people also see that it's cheap, they'll rush for it. Once people start rushing for a particular stock, the price will start going down based on demand and supply forces. It will go down, to respond. So you gain more value when you invest in cheaper stocks. So let's always try to look out for stocks that are cheaper, that are trading cheaper. If you don't have the expertise, you can contact people and they can help you with that. Also, we have income investing. Income investing is a great way to build wealth over time. It involves buying securities that generally pay out returns on a steady schedule from time to time, like bonds. Bonds pay interest usually every 6 months or every year. And you know that every 6 months, your principal is safe, but you're getting a certain stream of income at a certain rate over time. Growth investing. Growth investing more or less like value investing. For that one, you invest in a company that you believe that on the average, it has a great potential to be more profitable. And with that conviction, or with that, and on the back of that analysis, you invest in it because you know that these guys are doing well, or this industry in the next 2 or 3 years is going to boom. So any company that is reasonable, that has issued any stock, I will invest in it. Even if the price looks high, I will invest because the growth potential in that industry in the next 2 or 3 years is going to be great. So by that, you invest and you take the risk that it will happen or it will not happen. But once you are convinced you have done your research, I'm sure it will happen and you'll be happy. Social responsible investing, we have to be socially responsible in our investing pursuits. You don't want to invest in just any company who comes around, destroying the environment. So these are all things that we need to consider in our business strategy. Other than that, you invest in a company that will pollute your environment, and you go back using the returns that you have made on that investment to cure your disease. By so doing, you have not been strategic enough. So these are a few ways we can be strategic in our investing. How to choose an investment strategy that is right for you. Now, when choosing the right investment strategy, there are questions that you need to ask. What is your investment horizon? How long do you want to invest? Am I investing to buy a car? How soon do I want to buy the car? Do I want to buy the car in 20 years' time? And that I want to take more risk. I want to buy the car in a year time, and I cannot afford to invest in a stock that maybe is in the next 3 years that will start performing. If I go and invest in a stock, I want to buy a car in a year, and the stock price goes down immediately, what happens to my money? It will rather deflate, rather go down. I may not be able to even buy the car in the year I want to buy it. So we need to understand how long we want to have our investments done. Then you also have to ask, what returns are you seeking to achieve? Are you seeking to achieve very high return? Then it comes with more risk. Then you need to have more patience. You also ask yourself, what amount of risk are you able to tolerate? I did advise that you have a friend, he may be willing to take so much risk because he has a fund that is that assets for him somewhere. But you cannot take that risk. So these are questions to ask yourself, and you need to make the right decisions. I've told you some investments that are less risky that you can put your monies in based on, your risk profile, like treasury bills, treasury bonds, certificate of deposits that are with good standing firms. Those are very good for very short-term investments. But if you want to make high returns, you want to go equities, that's another option. But then you need to examine your risk profile. Let me look at this. So let's look at this briefly. So you want to buy a car in 3 years, you could look at some short-term bonds, you could look at some short-term bills, or a mutual fund with short-term bonds, like 2-year notes or a 3-year bond, or that invests in treasury bills and maybe it rolls it over time. That could be safer for you. Maybe you want to invest in something that can help you pay your kids' fees in the next 15 years. Doing a balanced mutual fund. A balanced mutual fund is a fund that usually considers different asset classes with different level of risk. Let's say to be a combination of equities and let's say some bonds. So it is balanced in such a way that the portfolio is protected with some fixed income investment vehicle or investment products, so that in case the equities is not doing well, the fixed income can be of support. But if it's for a 15-year period, you are assured in one way or the other that at some point the value of the stock will go up and the share will go up, and it will benefit you big time. And sometimes the upside of equity investments can be way higher than even bonds or treasury bills or whatsoever. But like I said, the risk can equally be high, assuming the company at a point in time starts to perform bad. So these are things I need to consider. You're investing towards your retirement in 30 years. You can invest in stocks, stock-focused mutual funds, and other long-term investments that will meet your risk profile and appetite. So we need to know how long we want to invest, and then we can know the kind of securities or investment product that we need to invest in. My final thoughts. Say do not go into debt to invest, because if the investment go bad, you'll be in double debt. So let us take that clue. Now beware of agency problem. There are a lot of people, they are agents, and they'll come and try to convince you to do certain things, mainly because they are an agent, and when they do you, they will get a commission. Or someone will come and tell you, come and join this, because when he or she lets you join, he's going to get some commission, or he's going to get some point that will earn him money. So people will start trying to sell all sorts of investment ideas to us. But I want to advise that let us try to, as much as possible, be on the safer side. Because sometimes being on the safer side for a very long time can really pay and pay well. But being on the riskier side, even for the short term, can make you lose everything. And say, listen to the spirit. Say, if it seems too good to be true, it is probably problematic. So I would like to end here, and probably if there are some questions, we can take them, I think, before our time is due. Thank you very much.
So thank you, Mr. Obed, for such an insightful presentation. We have two questions here which we would want you to address for us. Now, the first question is, who is eligible to invest in government bonds and stocks? And the second one is, where can we go to buy stocks or bonds?
All right, so for government bonds and stocks and all that, everyone is eligible to invest in there. Even for children, their parents can do that. And any other person at all can invest in. Even for some of our investment, for some of our treasury securities like bonds, even foreigners are able to invest in it. So I would say that everyone is able to invest in treasury securities like bonds and then treasury bills. And then for the institutions we can go to, we have an institution like IC Securities, Ghana. If you check the internet, you can find them. You can call them, and then they can take you through. We also have the Tam Bank and there are other investment brokerage firms in Ghana. If you can go into the internet, you type investment brokerage firms in Ghana, you get a list of them. You can contact them, and then they can help you out and even provide you with some expertise advice to meet your investment goals and objectives.
Thank you very much for joining in with us today. I hope it was as insightful as it was to us. So our next webinar would be on the 25th of April. We hope to meet you there. And then if you have any follow-up questions on us, you can kindly follow us on our social media platforms, that is Connect Consult. And yeah, we'd love to meet you guys sometime. So thank you very much, and then have a great day.